that's the tipping point, right? That to me is, like I said, our thesis on this podcast and all our work has been that the AI boom is going to last until it's not. And that we're going to have about a 12 to 24 month runway here for a melt up, a massive melt up, and then probably some massive, massive crash. That massive crash is not going to be caused by credit cockroaches and auto. That massive crash is not going to be caused by, some trade spats between the US and China that aren't really all that important.
Mhm.
It's going to be caused by exactly what you just said. The crash is going to be caused by consumers just flat out breaking. The AI boom's kind of like an onion, right? There's a lot of layers. You just keep peeling back, and there's more to find. There's so many verticals and so many niches and so many corners of the AI boom. But I think you can distill it all into five major profit driving forces. The first is what I call the bazooka.
Hello and welcome to Being Exponential with Luke Lango, where we'll cover the economy, markets, technology, and lifestyle all from an exponential perspective. I'm your host, Brooke. It is October 21st, and let's dive right in. All right, Luke, yeah, I know we missed last week, but you were on vacation with your family. Tell me about it.
Yeah, we went off to Europe. Took the kids across the Atlantic for the first time ever. A little bit of cautionary commentary here.
Right, right.
Taking two kids under five on a 10-hour flight is a challenge that most parents should probably not embark on. But we did, and we accepted the challenge, and the kids were
Yeah.
actually surprisingly better than I thought they would be. But it was a fabulous trip. Really happy that we did it. Really happy to get my kids exposed to different things, different ways of life. They're SoCal born and raised, and then now Arizona, so they got the Southwest flavor, but they need to see a little bit more than that too.
Gotcha. Were you there for when the Louvre got broken into?
Oh, so we were in Paris the day before on Friday.
Ah, okay, okay. Yeah,
And
fun,
Lou, I think,
fun.
got broken in on Saturday morning at 9:30. So technically, we were still in Paris. Technically, we may have done the robbery and snuck those diamonds on
Who
the plane
knows? Who
from
knows?
Paris to Phoenix.
Check
That
the
could
diaper bags, right?
That could have been, yeah, check the diaper bags. That could have been us. No, that was wild though, right? What a
Yeah,
story.
pretty crazy. Broad daylight. That's nuts.
What, 9:30 a.m. All the police are what, getting their croissants and their cappuccinos or whatever, and then
Yeah.
they get that's yeah, that's incredible. Truly incredible.
Okay. Well, I've been telling people I can't wait for the Netflix movie in like 2 years, but that's
I wonder if we'll get the guys. I wonder.
we'll see. But back to the real world. I want to start off pretty strong here. So Jamie Dimon over the past week, in
Mhm.
terms of the private lending market and a couple of bankruptcies that happened, pretty recently, he said, where there's one cockroach, there's probably more. And this is in regards to First Brands and Tricolor, two interestingly enough, uh, brand companies, that auto part companies that went under, and they were heavily funded by private lending, private equities, and it can be taken as a precursor of a upcoming crash, upcoming impending crash. I just wanted to get your take on that, Luke.
Yeah, so the auto market is, I mean, it's tits up right now. Like that's what it is. The auto market is completely screwed. Nobody is buying cars. Cars are prohibitively expensive. Financing rates for them are very expensive. I mean, double-digit financing rates on a lot of new and used car loans. And I mean, unlike a home, like homes are financed too, but you need to live in a home. You need to have a home, or rent a home. You need to have a place to live. You do need a car, but you don't need a new car. You
Mhm.
can run your car up to 100,000, 150,000, 200,000 miles or more in some cases. And a lot of times, there's 5, 6 year cycle on cars. By that time, you're at 70,000, 80,000 miles. So in a low rate environment, yeah, at that point, you swap in and buy a new car. But in this rate environment, maybe you look at that 70,000 mile odometer and you're like, You know what? Let's push it to 100. Let's push it to 120. Let's push it as far as we can push it. So no one's buying cars, and the car market is completely dead. Now that's where you're seeing the credit cockroaches come out because economic activity in that sector is completely stalled. It's dried up, and when economic activity in the sector dries up, the companies that are really levered in that sector, they don't have the money to pay back their leverage, to pay back their debt, to pay back their loans, and so they default. That's Tricolor, that's First Brands, and you're seeing some regional banks warn of that. So, yes, there are credit cockroaches in the auto market. There are probably also some credit cockroaches in the consumer credit card market. Consumer credit card balances are completely maxed out right now.
Right.
A lot of people are really late on their credit card payments. I think the percentage of Americans that are late on credit card payments is at its highest level since the great financial crisis. I believe that's the data point that I read recently. Um, so there's credit cockroaches in auto. There's credit cockroaches in consumer credit. I think there's probably some credit cockroaches in commercial real estate, but I think that we've been hearing about that for 2 or 3 years. I think that is actually a safer place than auto and consumer credit right now. So where I am concerned and where I do think, there are flashing red signs, not even yellow, flashing red
Mhm.
signs are in auto and consumer credit. Now, some credit cockroach problems are big enough to derail the whole system. 2008, we had credit cockroaches in homes. That's a 14, $15 trillion market. Everyone's exposed to it. Every big bank, every regional bank, all banks everywhere carry mortgages. A lot of them. They were really tied up into those. Americans, our home is our center of life. It is the bedrock of our way of life as well as the source of most of our net worth, right? I mean, especially in today's economy, 50, 60, 70% of people's net worth is tied up into the equity value of their home. So when you have credit cockroaches in the housing market, the residential housing market, like you have in '08, that's enough to derail the whole system. Not so much in autos. There are a lot of credit cockroaches in autos. I don't think it matters. That means really bad and tough times for the automotive market, but that's a 1.5 trillion dollar market. I mean, we're talking a 15th of the size of the residential home market. Not that big. Um, when you talk about a car in respect to how important it is to a consumer, not all that important. I think when I buy a car, I expect its value to depreciate. When I buy a home, I expect its value to appreciate. So when my expectation for home value appreciation turns into depreciation, that's, the negative wealth effect there is significant. But I think my car is going to decrease in value every single year. So if it decreases a little bit more, a little bit faster than what I was expecting, not much of a negative wealth effect there. Cars are also $40,000 to $100,000 purchases, not 400,000 to $1 million or $2 million purchases. So we're just talking about a much smaller market in terms of scope here. And so though there are credit cockroaches in autos, I don't think it's all that worrisome. I think it says you need to avoid the auto stocks, you need to avoid auto parts suppliers, you need to avoid that whole supply chain, but it's not going to derail the economy, and it sure as heck is not going to impact the AI boom because Meta doesn't care if people are defaulting on their car loans. Microsoft doesn't care. Amazon doesn't care. I mean, what does that have to do with me spending hundreds of billions of dollars and building AI data centers? It does not. It has nothing to do with that. And meanwhile, if you're looking at banks, regionals are really exposed to autos, but not the big boys, not JP Morgan, not Bank of America. They're not really exposed to autos. So they're going to still have all this lending capacity to lend out to companies like CoreWeave, who highly levered, AI infrastructure play. I don't think the lending markets, the capital markets, the credit markets for AI dry up at all because of some credit cockroaches in auto. They're completely separate. So from that perspective, I understand the concerns. I get what's going on, but I'm not derailed by them. I remain very bullish on AI stocks. If anything, it emphasizes what we've been talking about, which is the K-shaped economy that we have, where
Right.
the AI economy is absolutely booming and thriving and proving resilient to high rates and high inflation and low growth, but the everything else economy is completely struggling. And part of that everything else economy is the auto market, which, like I said, is completely dead right now. I think that spells worry time for a company like Carvana. I think that spells worry time for a lot of the automakers. So yes, there are some read-through implications of this of what to avoid in the market, but one of the read-through implications is not that the AI boom is going to end. No, the AI boom is going to persist well past these credit cockroaches in autos.
Gotcha. Yeah, I did kind of want to reiterate there the K-shaped economy in regards to this particular thing. Like you're saying, it is relatively siloed to the car market. But I did want to bring up private lending again in terms of companies like Klarna, where we have people paying in installments for burritos. And Klarna put out a report where people are defaulting on those. People are defaulting on their DoorDash orders.
Mhm.
So it really speaks to if maybe when there is an AI boom, it's going to be this total collapse in the market. If we have people defaulting on burritos and that boom pops. I wanted to get your take on something like that
Yeah,
happening.
well, that's the tipping point, right? That to me is, like I said, our thesis on this podcast and all our work has been that the AI boom is going to last until it's not, and that we're going to have about a 12 to 24 month runway here for a melt up, a massive melt up, and then probably some massive crash. That massive crash is not going to be caused by credit cockroaches and auto. That massive crash is not going to be caused by some trade spats between the U.S. and China that aren't really all that important.
Mhm.
It's going to be caused by exactly what you just said. The crash is going to be caused by consumers just flat out breaking. That they cannot. So, like I said in a previous podcast, when everybody's struggling, humans, it's all relative, right? When everybody's struggling, you don't feel like you're struggling that much because you're all
Hmm.
struggling together. There's some community sense, and we're all struggling together. But when a certain portion of the economy, in this case, 95% of the economy, is struggling, and then you see the other 5%, that little corner called AI, and it's just absolutely thriving, that creates resentment and that leads to a breaking point. So when you have people defaulting on installments to buy burritos, and then you have Nvidia and OpenAI doing $100 billion deal, and all these stocks, AI stocks surging, hundreds of percent all-time highs, the rubber band gets stretched too thin. That's the breaking point. That's the crash. That's what's going to cause the crash. That's going to happen. Now, I think it's going to be caused by and what's going to actually spark it is going to probably be a rerun of the 2022 style inflation. I do think we're going to get some more inflation in the pipeline. One of the big drivers there, tariffs are in the mix, but the bigger driver to me is energy costs.
Hmm.
That I think energy costs are going up dramatically because of AI. Bloomberg just came out with an article that said, in areas where these AI data centers are being built, energy costs are up like 150% in the last 2 or 3 years. Like they are spiking. And that's
Yeah.
only going to continue because we're building more data centers. We are building more data centers. So these AI driven energy cost increases are going to continue. And I think that's going to cause another wave of inflation. Probably in late 26 going into 27, and that's what breaks the back of the consumer finally. And then you're going to get some over automation spiral. The companies are going to try to protect their profits by automating out jobs. Today, news broke that OpenAI has put together a team of ex investment bankers that they're paying $150 an hour to train its AI models to do financial modeling, to do basically banker grunt work. Now, the title they're running with, Bloomberg put out an article, was like, OpenAI hires team of ex investment bankers to eliminate junior bankers grunt work. Somebody copy and pasted that in one of our company Slack channels, and I responded and said, "What a misleading headline. The real headline is OpenAI puts together a team of ex investment bankers to eliminate junior bankers." period. Not their grunt work, to eliminate the workers, period. So you're going to get this over automation spiral in combination with this reinflation wave. And that's what I think causes this boom to at least pause and causes an AI stock market reset. Like I said, probably in late 26, early 27. You got to watch the inflation trends. So that's something that we're watching closely. But it's not going to be credit cockroaches and auto. And
Gotcha.
it's not going to be here and now.
Yeah. On that bankers training out there, their proteges essentially. I did see a report about Uber using their drivers outside of the driving hours to upload data, so they're getting more data training that way. So it's just another wave of data training to make AI better. And
Yeah, it's kind of crazy that these people are falling for it, right? That
yeah,
like you're being used to replace yourself. Like you're
replace
being used to
yourself.
train something that's going to replace yourself in the future. But I think it speaks to the desperation of the consumer today. The consumer
Yeah,
is not in a good place. Consumer sentiment is washed out. Inflation is still like 3%. Rates are still high. Those post-COVID savings have been completely wiped out. A lot of people are not invested heavily in the stock market, not reaping the rewards of this AI stock boom. So you're just seeing the consumer is not in a great place. And so much so that they are even accepting gigs. They know. I think these Uber drivers
they know.
know what they know they're replacing themselves, but
And they're
they
getting
don't care. They need the
fleeced.
money now. They need the money now. And so it's like you got to fill the immediate need, even if it comes at a long term consequence. And so, yeah, again, the rubber band just getting stretched really thin. They're really far, but it's not going to snap because of credit cockroaches and auto. It's not going to snap because of these little trade spats. It's going to snap once you get a reinflation wave, likely because of AI. Once rates don't come down, savings really do get wiped out, and you get an over automation spiral. And again, we're not there yet. I
Yeah.
think here and now, we're in the clear. Stocks have runway to continue to push a lot higher, but yeah, like I said, 12 to 24 months down the line is when, based on my work, where inflation could be, where energy costs could be, where rates could be, where savings could be, you kind of extrapolate that out, forecast that out, and we could be in the trouble zone in the next, year or two.
Roger that. I did want to pivot to something you mentioned a little bit earlier regarding a China-US trade war. So right
Mhm.
around 2 weeks ago, China placed more restrictions on their rare earth metals exports. And now we
Mhm.
know they control around 90% of that market, and that is one of the reasons Trump has been making this portfolio to hedge against that.
Mhm.
Some might consider it a self-fulfilling prophecy in terms of the US because of the increased tariffs they put on China and just kind of escalated this tension potentially. But
Mhm.
I did want to get your take on that. I know we've talked about MP Materials and companies of that nature to benefit ourselves, but like where do we go from here now that China's actually taken a step forward in the trade war of sorts?
Yeah, I think we're going to see more investments. I think we're going to see more stuff get nationalized because, well, really what's happening is the US is realizing, and I think correctly,
Hmm.
that maybe we missed the starting gun on the AI race. That there are a lot of benefits to free market capitalism, and I am a huge proponent of free market capitalism. But it wasn't free market capitalism that led us to creating the atomic bomb in the 1940s before the Germans. That was the government intervening to say this is a priority and we need to do it. Every once in a while, free market capitalism does break under urgent, dire circumstances. And I think that's where we are right now. I think we are in a race with China to develop AGI, artificial general intelligence. And we should be miles and miles and miles ahead. There is no reason they should be competing with us. There is no reason this should be a race. It should be the Los Angeles Lakers playing your local high school basketball team. That's what it should be. The score should be 98-5 because we have the biggest companies, we have the most money, we are the center of the economic universe. All of these great AI models are US AI models. We have the infrastructure, we have everything we need to be the LA Lakers put in a freaking pounding on your local high school team, but we are not. We are in a tight race. It is the Lakers versus the Warriors. It is the Chiefs versus the Eagles. This is a tight race right now. This is a close game. How? Why? How are they competing with us here? I think because they abandoned free market capitalism and put all of their eggs into this basket. Chinese government supports Baidu. They support Alibaba. They support their AI heavyweights, and they support their AI infrastructure, and they support the creation of energy to support that AI infrastructure. So they're really big into this, and they've monopolized the rare earths market. So I think the U.S. is realizing, you know what, maybe we need to do some of that. And we are doing that now. We are moving forward with doing that. You can call it state-backed capitalism or socialism or communism. And I think there's an argument for any one of those terms. But really, zooming out, I think it's survival. That if we do not do this and we allow China to continue to uh, allocate resources in a way that we don't towards artificial intelligence, then they could win the race. And whoever wins this race, their values, their economic systems, the way they look at the world, that's what's going to proliferate over the next 100 years. I mean, look at the atomic bomb, right? Had Germany got there first, Amazon Prime has a whole video series on this, right? A whole TV show. Like, what if the Germans got the bomb first? I mean, the world would look completely different. The
Right.
values of the global economy, the center of the global ecosystem, of the economic system, would not have been America, it would have been Germany, and everything would have been different. That's what's at stake here with AI. That either we win or China wins, and whoever does win is the center of the universe for or the world for the next probably 100 or more years. So I think we need to misallocate, if that's kind of the word you could use here, misallocate resources, force allocate resources into artificial intelligence. And the recent trade spat with China, between the US and China, it's all about rare earths. And it shows how far, to what lengths these countries will go to support their AI initiatives, to support their AI efforts. And it's to the edge of the world. That's how far these countries will go. And I think we're going to see more investments from President Trump, from the White House on this front. Love it, don't love it. What you can love about it is the amount of money that can be made by potentially front running these investments, right?
Mhm.
I mean, the president's portfolio, as we like to call it, there's four stocks in it right now. You got Intel, you got MP, you got Lithium Americas, and you got Trilogy Metals. All four of those stocks rallied more than 80% in less than 2 months as a result of the White House investments, right? Intel jumped what 80 to 90% in 2 months, and that was the slowest one. Trilogy Metals went up 200% in a day. MP went up 200% in about 2 months. Lithium Americas went up about 100% in a day, right? So love it or hate it, it's happening. I think it's going to continue to happen. This president's portfolio is currently at four. I think it's going to get to, there was rumors about critical materials, CRML. That could be a fifth one. I think USA Rare Earths, USAR. I think that could be a sixth
Mhm.
one. NB is another kind of rare earths player in here. Cleveland Cliffs, CLF. They're getting into rare earths mining or expanding the rare earths production. So, like, I think there's a lot more that can happen here. I think that portfolio four can go to 10 or 15. And I think it's going to be focused on resources at first, those natural resources that China has a chokehold on, but it's going to expand across the whole value chain. It's not just going to be resources. It's going to be resources. It's going to be the manufacturing of chips. It's going to be everything from the dirt in the earth to the end application. I think the White House takes a stake across the whole value chain. And that's how this portfolio gets to 10 to 15. And perhaps one of the best investment strategies, again, you don't have to like it. You don't have to hate it. You don't even have to have no opinion on it. But what you can acknowledge is that this trend creates enormous investment opportunities for people like you and me that just look at stocks and say, hey, maybe they're going to buy this one. Maybe they're going to take a stake in this one. Maybe they're going to take a stake in that one. Maybe they're going to take a stake in this one and buy those stocks before they do and bag 100%, 200% return in a day or a week or just 1 to 2 months, right? Like, that's a great strategy, I think. So we're putting together a list of stocks that could potentially get equity stakes. Like I said, USAR is one that I think is probably next up. NB looks like it could win some money. These are GFS, Global Foundries, like moving up the value chain to more of the manufacturing of this stuff. I just think there's a lot of companies that could win White House investments, and as we've seen with Trilogy, with MP, with Intel, with Lithium Americas, these were all stocks that were dead in the water.
Right.
Intel went nowhere. Intel went down forever and ever and ever and ever and ever. And then all of a sudden, boop, got the investment, and now it's one of the best investments in the market. MP went nowhere for a long time. Boop, White House investment soared. Lithium Americas went nowhere for a long time. Boop, White House investment and it soared. Trilogy Metals nowhere for a long time. Boop, White House investment and it soared. So there is momentum here, and I would play the momentum. I would not ignore it.
Of course, yeah. I mean, full transparency, I made a little bit of money on that MP materials. But I guess the topic at large does bring up an interesting ideological discussion about does capitalism breed innovation? And then, we have probably the most capitalist coded president of all time nationalizing companies. So it is a pretty fascinating time in the markets in general.
Yeah, I mean,
But
if we talk about it philosophically, like you can always walk it back,
mhm,
right? Like the atomic bomb, like that was an effort that was not free market capitalism, and then we walked it back, right? Then we became the most free market capitalist
right.
country in the world after we got the bomb. So maybe we can walk it back, but then you have to think like, let's just say we don't do this. Let's say that we do free market capitalism and we still win the AI race, and AGI becomes a thing. Is free market capitalism going to be alive in the presence of AGI?
Likely not.
Yeah, I don't know the answer to that. I know AGI changes the calculus. I know AGI changes the game. Does free market capitalism work when you have a
All knowing,
sentient?
yeah, all
Yeah, yeah.
knowing.
I mean,
Yeah.
there's this omniscient, omnipotent entity or thing that I mean, then it becomes AGI backed capital. Like I don't know, right? Like it's
Mhm.
the game changes when we get there. So trying to preserve free market capitalism to an endpoint where we get to AGI and then everything changes after that. It's like, well, maybe we should just kind of change it a little bit before to make sure we get to AGI first, and then we'll deal with the AGI problem when we get there. But I'd rather be dealing with an American AGI problem than a Chinese AGI problem. And so that's why I think they're doing what they're doing, and that's why I think it's going to continue. And again, there's a lot of philosophical arguments to be had here, but from my perspective, my job is to find investment opportunities in the market, right? Find compelling stocks to buy that can go up a whole bunch in not a lot of time. And this trend provides that. It provides exactly that. And so I'm focusing on that. I know it's going to keep happening, and so I'm going to find who's next.
Now, I do want to take another step back, if you will, and look at the markets at large. So we have earnings season is here and approaching. Um, Everything we've been saying, the earnings kind of runs counter to that. Over 80% of companies that are reported already have beat analyst expectations.
Hmm.
Um, the market is looking strong, no matter what anybody says. However, valuations are really high, especially regarding the Magnificent Seven.
Hmm.
So we have a market where those AI companies almost need to beat before, or else we might see a correction. What do you say about that, Luke?
Well, that's absolutely true. Stocks don't fall because of high valuations, but stocks can crash because of high valuations if they don't meet estimates, right? High valuations they bake in a lot of growth expectations. And so when companies don't meet those growth expectations and they're at high valuations, then yes, the stocks can crash. That's what happened in the dot-com boom, right? We had these elevated valuations, but we had elevated valuations for several years. I mean, the forward P multiple on the S&P 500 was above 25 times for like 2 or 3 years straight, but the stocks kept going higher because the companies kept meeting or exceeding those elevated growth expectations until they didn't. So this AI boom, much like the dot-com boom,
Mhm.
will persist. So screw the valuations. The valuations are just like a yellow flag. They're not a red flag. They're a yellow flag saying, hey, if these companies stop meeting expectations, the potential downside is enormous. That's a yellow flag, not a red flag. Stocks don't fall because of high valuations. They fall a lot if they don't meet expectations. when they're trading at high valuations. They're going to keep meeting expectations for the foreseeable future. This AI boom will persist, will roll on so long as companies keep meeting or exceeding expectations, and they're going to do that this Q3 reporting season. Look at the amount of deals that have been announced. You got OpenAI and Nvidia, $100 billion tie-up. The AMD OpenAI deal, that's probably going to be over time $100 billion. You have these massive deals being struck right now. I mean, truly enormous deals being struck. That's money flowing into the AI ecosystem. That's $100 billion that flows into the system. It's going into data centers. That means Veritiv's going to be selling cooling equipment. That means Arista Network's going to be selling networking equipment. That means Sienna is going to be selling networking equipment. Then Lumentum, LITE, is going to be selling optical transceivers and stuff like that for data transfers. That means Pure Storage, PSTG, is going to be selling data storage solutions. So when I hear these big headline deals, what I see is money flowing into all of these different companies because of that big headline deal. So that means all these companies are going to be beating expectations this Q3 reporting season, and they're probably going to be beginning Q4, and they're probably going to be beginning Q1 because these are long-term deals. These are not short-term deals. And so I think the money is just flowing really, really well in the AI ecosystem, and that money is going to show up on the financial statements when they report numbers. Revenue growth going to be great, margins going to be expanding, profit growth going to be great, cash flows are going to look good, the guidance is going to be strong, the commentary is going to be bullish. I just think you're going to get a lot of really good stuff from AI companies, from tech companies, this reporting season, and I think it's going to be focused again on that kind of AI infrastructure layer where the money is flowing first, just to build the data centers. So that's how I feel about this earnings season. I think it's going to reawaken the bull market in AI stocks. AI stocks they've been on quite a tear. Since the last reporting season, the S&P 500 is up about 6.5%. The Nasdaq 100 is up more than 8%. A lot of AI stocks like Bloom Energy, EOS Energy, Grail, they're all up more than 100% since the last reporting season. So we've seen big rallies across the spectrum since the last reporting season. Now, in the last 2 weeks, stocks have kind of taken a breather, especially AI stocks, and I think that pause ends with the Q3 season. I think we get great numbers. You reawaken the bull market in AI stocks, and they push higher and they rally another. The Nasdaq rallies another 7 or 8% into the Q4 season, and you get a handful of AI stocks that rally 100% into the Q4 season. So I think the pause that we've seen over the last few weeks ends in the next few weeks, and this rally kicks back into high gear.
No, I think that's a perfect segue into something I wanted to ask you about, Luke. So clearly you're in a hotel room. You are at a conference. And then I heard you spoke about five profit driving forces of AI. I'd love for you to bring that up.
Yes, I'm at the Stansberry Research Alliance conference here in Las Vegas. I was asked to speak this week here. And I spoke on, my presentation was on the five big profit driving forces of artificial intelligence because I think that the AI boom is still alive and well. And that all you need to do over the next 12 to 24 months to make money in the stock market is make good money in the stock market, is harness the true profit driving forces of artificial intelligence. And so I think there are five major profit driving forces that when you kind of peel back, the AI boom is kind of like an onion, right? There's a lot of layers. You just keep peeling back, and there's more to find. There's so many verticals and so many niches and so many corners of the AI boom. But I think you can distill it all into five major profit driving forces. The first is what I call the bazooka. The second is the crunch. The third is the resources. The fourth is the applications. And the fifth is the embodiment. So those are my five profit driving forces. Number one, the bazooka. We just kind of talked about that.
Mhm.
NVIDIA, OpenAI, $100 billion deal. There's this bazooka that all the big tech companies are loading with cash, hundreds of billions of dollars, and they're firing it into a very specific corner of the economy called AI data centers. They're just building AI data centers. So get in that blast radius. That's the first profit driving force. You have Meta, Amazon, Microsoft, all of these massive OpenAI, all these massive companies. I think projected capex among the big tech firms is like $500 billion for this year. Morgan Stanley, Bank of America, they all think it's going to rise towards $1 trillion by 2027, 2028. Now, to put that in perspective, building the entire highway ecosystem, the U.S. highway system in the 1950s to the 1980s, that was about a $500 billion project over 30 40 years. The railroad system in the 1800s, that was about a $700 billion project in modern dollars, in today's dollars. About a $700 billion project also spanned over about 30 to 40 years. So those are the two biggest infrastructure projects America's ever seen. $700 billion over 30 to 40 years in the 1800s, and $500 billion in the 1950s, 60s, 70s, and 80s, again, over 40 years for highways. Now we're getting $500 billion in one freaking year in 2025. And that's going to grow to $1 trillion in one freaking year in 2027 to 2028. You add it all up, and over the course of five to 10 years, right, throughout the 2020s, I think when all is said and done, from 2020 to 2030, I think you're going to see AI related capex exceed $5 or $6 trillion. That's tenfold the highway system. That's eight or sevenfold the railroad system. So we are talking a massive bazooka here that is firing. One of the best ways to profit from AI is to get in the blast radius. Again, I see that $100 billion from OpenAI and NVIDIA, and I think that means Arista Networks is going to sell a lot of networking equipment. That means Cisco is going to sell a lot of networking equipment. That means Veritiv is going to sell a lot of cooling solutions. That means Pure Storage is going to sell a lot of data solutions. So, like, I see those deals and I see all the companies that are going to win a bunch of money as a result of them. That is the first profit driving force. Get in the blast radius of all this big tech capex. Number two is the crunch. The crunch is the energy crunch, the supply crunch on energy that is going to be created because of all of this AI data center construction. You build a data center, it needs energy. We do not have enough energy to supply that. Estimates suggest that of all these data center projects that we're trying to build right now, I mean, these hundreds of billions of dollars worth of data center projects, they all come online by 2028, 2029, 2030. You look at all the energy that we have in America, and then you add in all the energy that's expected to be added, and we're still going to be like 30 to 40 gigawatts short. There's going to be a shortfall of 30 to 40 gigawatts of energy to supply these massive AI data centers. That's the crunch. That's a supply side crunch. So Profit Force 1, get in the blast radius of all this big tech capex. Profit Force 2, find the companies that can fill that supply side crunch, that supply side gap for energy to power all of these data centers. That's the power generation layer. Now, there's two layers here. There's the power generation and the power storage. So power generation, we're talking Constellation, CEG, Vistra, VST. Those are IPPs, independent power producers. Then you're talking Oklo. Talk about them a lot on this podcast. OKLO. SMRs, nanoreactors, nuclear is going to be big in this AI energy build out. NuScale SMR, another SMR player. Cameco, CCJ, they provide uranium. Uranium is the fuel source of nuclear. So there's all the, I think nat gas, there's some nat gas plays in there too that I think are pretty interesting. Then there's the power storage layer, the energy storage layer, which is okay, you need these data centers to have access to a bunch of power from the grid, but if the grid fails, the grid breaks down, when there's a blackout, you need to have on-site backup power because you can't have a data center go down, right? We saw AWS go down
Hmm.
yesterday, and it was like havoc, right? I had friends messaging me, I can't work right now. There's nothing I can do. Oh my God. It's like the world breaks when cloud goes down, okay? So with AI data centers, you can't have them go down. So you need on-site backup power as well in case the grid, blacks out. That's where a name like Bloom Energy, BE, that stock's been on fire. They do fuel cells. They just had a big deal with Brookfield so that when Brookfield, massive asset manager, goes out and builds these data centers, they're going to put a Bloom Energy fuel cell system at the data center as on-site backup power. EOS Energy, EOSE, they just won a big deal. They do battery energy storage. So there's really two forms of storage. There's BESS, battery energy storage systems, and then there's fuel cell systems. Bloom does fuel cell, EOS does batteries, Fluence does batteries, FLNC. These are three names that I think really succeed in that energy storage layer of the crunch. So Profit Force 1, get in the blast radius of all this big tech capex. Profit Force 2, find the companies that can fill that supply side gap, the crunch of energy that's going to be needed to power these data centers. Number 3, we've kind of talked about it, the resources. This is where the president's coming in, the White House is coming in. We just need to nationalize resources. We need to build more resources, and that is happening right now. Can't have it all come from China. So look at rare earths, NPUSAR, look at lithium, Albemarle, LAC. Look at all of these. There's a whole bunch of metal. Copper is a big one even now. So FCX could get some love there. Cleveland Cliffs with CLF, that's a ticker there, getting into rare earths. That's interesting too. So there's a lot of profits to be had at the resource layer, especially with the nationalization that's going on. And then number four is the application layer, right? We're building all this stuff so that we can make cool services, make cool software with AI. That's where you're finding names like Palantir. Palantir is the poster boy here. They've been the biggest success story at the application layer in terms of AI software. I think they're going to continue to be a big winner. Again, you got names like Axon. You got names like Guidewire, GWRE. You got names like Lemonade, LMND. These are great AI appliers, AI software stocks that are taking all this infrastructure that's being built and developing really cool AI models on top of it and applying them in value additive ways to very specific verticals or niches of the economy. Now, the risk here is LLM commoditization. That LLMs are getting so good that they are now doing the job of a lot of software. They're eating software. For example, Duolingo, language learning app. We used to love the stock. Now, not so much because ChatGPT 5 can whip up a very simplified language learning app in like a minute or two. So now Duolingo, ChatGPT is on its heels, right? And they got to keep running, and they are. They're a great company, a very well run, great management team. They're getting into math, they're getting into music. I love all the stuff that's going on there. But it's tough when you have
Mhm.
Sam Altman Co. right on your heels. Adobe, another great company, very well run, great business, great cash flows, great margins, great growth. But then you got tools, AI tools from Google, like Nano Banana, where you can just go in and edit a photo with a text prompt. Take a picture of me right now in my white shirt, put in a Nano Banana, type in change Luke's shirt to red, and boom, it turns red. Change my background to it's Photoshop. It's Adobe Photoshop with a text prompt. All of a sudden, Adobe Photoshop. Yes, they're innovating, they're trying to do different things, but now you got Google on your heels. So you got to be careful with LLMs and how good they're getting, how much more capable they are becoming, and that they don't eat the software that you are investing in at the AI application layer. So that's something to watch out for with that profit driving force. And the last profit driving force is embodiment. And that is essentially taking AI and embedding it into the physical world. So not just AI software, but AI robots, humanoid robots, warehouse robots, cobots, self-driving cars, autonomous drones. There's a lot of really exciting stuff happening here. One of the best performing stocks in the last year has been a drone maker that specializes in autonomous drones called Kratos, tickers KTOS. We've owned it in our breakout trader portfolio for a long time. That stock's gone from like 13 bucks. It touched 100, I believe, at one point. That stock's been on fire. That's embodiment. That's AI put into a physical device and rolled out into the world. Waymo, they're expanding into London now. So that's big. Now they're going international. Love to see that. Aurora is expanding their self-driving trucks. We've talked about them a lot on this podcast. Symbotic, that stock's been on fire. They do the warehouse automation for Walmart. We've liked that stock for a long time. Now it's really starting to wake up. I think it's at all-time highs now. Last I checked yesterday, it was around $70. So that stock is just doing really well. So you're seeing the embodiment layer really start to come to life in a pretty major way. Tesla stock. Look at Tesla stock. They sell less and less cars, and the stock goes up and up and up. And everybody wants to be like, oh, it's just a meme stock. It's not even a real stock. No, it's going up because of optimism around Optimus, the humanoid robot project.
Right.
So you're seeing just the embodiment layer is really starting to come to life in a big way. And that's why I'm really excited about that fifth profit driving force of the AI boom. So in a nutshell, those are kind of my big five: the bazooka, the crunch, the resources, the applications, and the embodiment. And if you follow those five profit driving forces, well, that's all you needed to do in the last 2 to 3 years to make money in the stock market. I think it's all you need to do going forward to make money in the stock market over the next 1 to 2 years, so long as this AI boom remains alive and well until we reach the breaking point that we talked about at the top of this call.
Yeah, I'm really upset I missed that Kratos recommendation that you had, Luke. Could you tell us a little bit more about Breakout Stocks, actually?
Yeah, sure. I'm surprised you missed that one. I know you follow quite a few of our trades in
Yeah.
Breakout Trader. Yeah, I mean we have a lot of success at Breakout Trader. I'm a fundamental guy. Everything we talk about here is fundamentals. But price is truth, and Breakout Trader is a service that we have that's dedicated to trading on price is truth. We trade technicals. We trade patterns, and the thing there is it's the strategy stage investing. Stan Weinstein pioneered it in the '80s, and it's this simple concept that at any given point in time, every stock in the market, really every asset in a financial market, is in one of four stages. It's either in stage one, going nowhere at a low level, stage two, starting to break out from that stage one consolidation and going up, stage three, now consolidating at a high level, stage four, declining from that high level. At any point in time, a stock is in one of those four stages, and the key to making money is to buy stocks when they're entering stage two. So that's what our breakout trader service is about. It's stage two investing. We've developed algorithms that allow us to try and pinpoint when a stock is going from stage one consolidation to a stage two breakout like Kratos. So we identified Kratos a while ago. It was kind of in the stage one consolidation for a long time. Our algorithms picked up as a potential breakout going into stage two. And man, oh man, it's been in a massive stage two ever since. Like I said, going from like $13 up to $100. Another recent success story he had was American Battery, ABAT,
Mm.
ABAT. That one went ballistic. That kind of got in that whole resource trade. That stock went from like $2 to $10 in a matter of a couple of weeks. It's pulled back a little bit now, but still in a solid uptrend. EOS was one that we picked up on in that service as well that had a massive breakout energy storage play. So although it's not a fundamentally driven product, it's all technicals, it's all charts, it's all patterns, it's all algorithms. It because price is truth, it lines up with our fundamentals, right? Like EOS is a name we've liked for a long time, just fundamentally, but now our technical analysis starts to suggest, oh, a real breakout is happening here because the fundamentals are supporting a real breakout. Same with Kratos. So it just kind of picks up on breakouts before the fundamentals get there, if that makes sense.
Yeah, perfectly. I do want to take another step back here. Transition to our exponential stocks of the week.
Yeah, sure. We got you know, it's kind of a theme that was emerging. I pulled up my screener and I looked at the stocks that are breaking out this week, and the theme that's emerging this past week
Mm.
specifically is AI biotech. So AI biotech to me is the last undervalued and undiscovered corner of the AI boom. That we've seen all these networking plays soar, we've seen all these data plays soar, we've seen all of these cooling equipment, the energy, the nuclear stuff soar. We've seen neo clouds like CoreWeave and Nebius soar. We've seen a lot of corners, niches, and verticals of the AI boom soar. One we have not seen soar yet is biotech AI. Yet there is so much potential in the overlap of biotech, medicine, healthcare, and artificial intelligence because so much data is
Right.
produced in those industries. And all you need really for a really good AI model to deliver really effective outcomes, really measurable, meaningfully positive results is a lot of data, right? Data is the fuel for the car that is AI. You give AI a bunch of data, you give a car a bunch of fuel, it's going to drive a long ways. You give AI a bunch of data, it's going to go a long ways as well. So I've always viewed biotech AI as like, hey, the market's getting this wrong. I don't know why the market's sleeping on all these great biotech AI plays. Now all of a sudden they're really starting to wake up. Our favorite there has been Tempest AI, TEM. That's one that's creating personalized healthcare solutions using AI, partnering with a bunch of big healthcare providers. That stock is breaking out in a big way, knocking up against $100 now. Love that one. But there are other ones that were on the breakout scan this week. Grail is one that's gone absolutely absurd. We can pull up the chart for that right now. Give me a second here. Grail has gone absolutely crazy, and I really like Grail. Here's the Grail chart. I mean, look at this. Yes, it was in an uptrend, but kind of a sluggish uptrend. Then it kind
Yeah.
of came down 200 day in August, and boom! I mean, look at this. It's gone from 30 to 90 since September 2nd. So we're 6 weeks into this rally, and we've tripled. That's pretty fantastic. I love Grail. They do early cancer detection tests. They use AI to essentially you go in, you get a scan, you get their Galleri test is what it's called, and they use AI to analyze the results of that test and try and detect if you have cancer at an early stage. Obviously, that's big because the earlier you detect cancer,
Mhm.
the higher the likelihood you have of overcoming it, of beating it, of having a successful result. So that this is an AI biotech play, and it's really waking up in a major way. Another stock that came across our scan this week is Beam Therapeutics, another AI biotech play. You'll see this chart kind of pretty dead for a long time. Still kind of dead if you look at the big picture, but all of a sudden this massive breakout off the $16 low to $30. This is a stock that has doubled in about 2 months, So that this one's really starting to wake up. Recursion Pharmaceuticals, RXRX, is another biotech AI that came across our weekly breakout scan. Again, this is one that's kind of been depressed. Like, look at this AI boom. It's been going on and going on and going on, and RXRX has done nothing. But now all of a sudden, it's starting to really wake up from 450 to 650, retaking the 200-day moving average. So you're seeing some big moves across the board in a lot of these names. Another one that was Celsius, CELC, is another one that's really woken up in a major way. So, like, you're starting to see a lot of biotech AI succeed. And I think that breakout has runway. You want to talk about stage two breakouts? I think biotech AI is entering a stage two breakout. And I think a lot of these names are going to do really, really well. Perhaps the best way to judge this is by looking at the biotech ETF, XBI, the Spider S&P Biotech ETF. Look at that. This looks like a legitimate major breakout for XBI. This is one that was kind of basing for a long time, had this massive stage four
Mhm.
decline from 21 to 22, base throughout 22, 23, and 24, but a ceiling on the stock was consistently right here. That was the ceiling, was 103. That was a high from January of 2022. We hit our head there multiple times in 24, never really meaningfully retook it. And now look, we've knifed above it. 103, now we're at 110. There was no resistance at 103, just boom, like a rocket ship took off. And now we are in clearly a stage two breakout. So I think this biotech trade has legs, and I think the AI vertical of the biotech trade is where you're going to want to be most exposed. So I'm really excited about what I'm seeing in biotech. And I think that kind of broadly covers the breakout stocks of this week. There were some other names, but like I said, 6 out of 10 of the names I was looking at this week for weekly breakouts were biotech names. So I think we need to pay attention to that.
Yeah, definitely. I think that's fascinating because the medicine aspect of AI was one of the big promises, right? But like, well, we'll cure cancer. So it's really cool to see. I guess we can call it an intrinsic value in the AI in terms of saving lives or preventing lives versus the relative value we've been seeing because we're making
Yeah.
money because money is being made.
Yeah, that was the thing is like it was always one of the early promises of AI. I
Yeah.
mean, you're absolutely right. And then it never got discounted into prices, maybe because stuff never really happened. But I think we are starting to see measurable, meaningful things happen with respect to applying AI to biotech. Like Tempest is doing some really cool things with personalized healthcare, and I think that's very much worth monitoring. And so I think these are great long term plays, but I think even in the short term the price is telling me, the technicals are telling me they got some torque. They got some torque right now.
Yeah. Yeah, that's a win-win. Now I think that's it for the episode. Is there anything we might have missed this week that you want to talk about, Luke?
Um, not really.
Yeah.
I can't think of much. I mean, we covered a lot of ground. I know we missed last week, so I wanted to cover a lot of topics. So I tried to speak at 100 miles an hour,
Right.
to keep it within an hour or so. But yeah, I'm really excited about where markets are. I'm really worried about where they will end up in the next year or two. But don't confuse that with the short-term bearishness. I mean, I want to reiterate to everybody, lock and load for the next 12 months. Like this is a quarter by quarter market. This quarter is going to be great. I think next quarter is going to be great. And so long as these companies keep meeting or exceeding expectations, which they will for at least the next, I think, 6 to 12 months, these stocks are going to keep on blasting higher. The best period for tech stocks ever was right before the
Mhm.
dot-com crash. From late 98 to early 2000, the entire NASDAQ complex rose almost 200%. I think it was 191%. That tripled. The entire NASDAQ tripled in about 16 to 18 months right before the big crash. So the best part of the party is always the last hour. You go to a bar from 10 to 2 a.m., 1 to 2 a.m. is the best part. You go to a ball game, it's the ninth inning that's the best part. Seattle Mariners versus the Toronto Blue Jays. I don't know if you caught the game last night, game seven. That was at eighth inning or ninth inning. George Springer comes up there. Boom, they're down 3-1. He hits it. Bam, gets that 2-run homer or 3-run homer. They go 4-3. Best part of the ball game is that eighth or ninth inning. Best part of a basketball game is the fourth quarter. Best part of a football game is the fourth quarter. Best part of a soccer match is the last 15 minutes. So, best part of a rally is the last year or two. We are in the last year or two. This is going to be the best part. Do not run away, embrace it, but be aware that it will not last forever. Watch for the warning signs, mostly watch the technicals, and when they start to waver, get out. But for now, they are not wavering. For now, they are flashing green, and that means you stay locked and loaded.
100%. Yeah, watch those technicals. I didn't watch that Mariners game, but I have been seeing a lot of that Shohei Ohtani talk. That was ridiculous. I'm not a baseball
Dodgers,
fan, but
Dodgers
those
4-0. Dodgers
that's
sweeping. Bring out the brooms. Dodgers are sweeping. I'm a Padres fan, so it pains me to root for the Dodgers since they are the rival. But when the Padres lose, I become a buy-in Dodgers fan. And Shohei Ohtani is an absolute stud, maybe the greatest of all time when it comes to
yeah, yeah.
baseball. Barry Bonds, I think, is still better, absent the steroid stuff. But what Shohei's doing both on the pitching side and on the batting side is absolutely crazy. What the Dodgers are doing is absolutely absurd. And I think that's a really interesting conversation to have. Everyone's like, oh, we need to bring in a salary cap now for the Dodgers. Like, no, you need to bring in a salary floor. You don't take away greatness. Try and make everybody else greater, right? Like that was
Yeah.
one of my things I had with I don't know, just my big thing is you should try to create a rising tide lifts all boats
It's all
situation, not
boats.
a strangle the leader situation. You know what I mean?
Yeah.
Like the Dodgers are, yes, they spend way more than everybody else, and that's why they're crushing everybody. Yeah, I get that. But as opposed to strangle holding them for what they're doing, creating a great team, maybe you should put in salary floors or incentivize other teams to spend more to bring up everybody else, not bring down the leader. That's how I feel about that situation. But in any ways, I don't like the MLB until the playoffs, and then in the playoffs, I'm a huge MLB fan. So that's all I've been watching recently is all of these baseball games. And that game seven between the Mariners and Blue Jays, that was something. That was a fun game.
For sure. Yeah, that tracks. Um, but yeah, I mean, that's been another episode of Being Exponential. We hope you've enjoyed watching. We've definitely enjoyed sharing our time with everybody. Make sure you comment, like, subscribe. We want to make it a conversation. But that's all for this week. We'll see you in the next one.